The silver market experienced a sharp contraction on December 29, 2025, declining from near record highs of $79.57 to approximately $75 per troy ounce within hours. This represented a 5.7% intra-period decline occurring during one of the thinnest liquidity windows in the financial calendar. For traders watching their screens that morning, the red numbers flashing across monitors told a story of apparent disaster. Positions that were profitable just days earlier suddenly showed losses. Stop-loss orders triggered automatically. Panic began spreading through retail trading communities online. Yet beneath the surface volatility, a more complex reality was unfolding that required careful examination. The timing of this price movement was not coincidental. December 29th fell squarely within what market professionals call Ghost Week, the 7-day period between Christmas and New Year's when financial markets operate at drastically reduced capacity. During normal trading weeks, the silver market processes billions of dollars in daily volume with thousands of active participants. Senior risk managers at major banks monitor positions continuously. Institutional trading desks maintain full staffing. Market makers provide consistent liquidity on both sides of the order book. But Ghost Week transforms this landscape entirely. Senior traders take extended holidays. Risk management teams operate with skeleton crews. The professionals who normally absorb volatility and provide price stability are simply not at their desks. Volume analysis revealed the scale of this participation collapse. Trading activity during the December 29th session measured approximately 30 to 40% of normal levels. In practical terms, this meant that orders which would barely move the market during regular periods now generated outsized price impacts. A sell order for 1,000 contracts that might shift price by 20 cents in February could move it by $2 or $3 during Ghost Week. The market had transformed from a deep ocean capable of absorbing large waves into a shallow bathtub, where every movement created exaggerated ripples. This liquidity vacuum created specific mechanical vulnerabilities. The electronic order book, normally dense with bids and offers at multiple price levels, became hollow. Bid support that traders relied upon simply wasn't there. When sell orders hit the market, they fell through multiple price levels before finding buyers. Technical analysts watching the charts saw what appeared to be a catastrophic breakdown. A massive red candle formed, the kind of price action that typically signals the end of a rally. Algorithmic trading systems, programmed to recognize such patterns, began executing their own sell programs. Computer traded against computer in a cascading feedback loop with no human oversight to interrupt the cycle. Yet the question remained, who was actually selling, and why now? The entities capable of moving markets this dramatically during thin trading periods are not retail investors or small speculators. They are large institutions with access to significant capital and sophisticated trading infrastructure. These are the same institutions that understand market microstructure intimately. They know precisely how thin the order book becomes during Ghost Week. They know that deploying even modest capital during this window can generate dramatic price movements. And they know where retail traders place their protective stop-loss orders. Stop-loss mechanics played a crucial role in amplifying the decline. Thousands of retail traders, having bought silver at $78 or $79, had placed automatic sell orders at $76 or $75 to limit potential losses. These orders were visible to institutional traders through order flow data. By pushing the price down to 75, large sellers triggered waves of automatic selling from retail accounts. Those retail sell orders then pushed the price lower still, triggering additional stops in a self-reinforcing cascade. The institutions that initiated the decline were then positioned to buy back the same silver at lower prices from the very traders they had shaken out. This raised a fundamental question that serious market analysts needed to address. Did this price action reflect genuine changes in silver's underlying supply and demand fundamentals? Had new mine production suddenly flooded the market? Had industrial demand collapsed overnight? Or was this simply a technical phenomenon, a temporary dislocation created by the unique conditions of Ghost Week trading? The distinction mattered enormously for anyone trying to make strategic decisions about capital allocation in the days ahead. While Western traders watched their screens in dismay, concurrent developments in Eastern physical markets were telling a markedly different story. While Western traders absorbed losses and questioned their positions, industrial buyers on the opposite side of the planet were engaged in entirely different behavior. They were not selling, they were not panicking, they were paying prices that seemed to exist in an alternate financial reality. The Shanghai Futures Exchange, operating in real time as New York showed $75, was clearing silver transactions at a price that defied conventional market theory. When currency conversions were calculated precisely, Chinese buyers were paying $89 per troy ounce for the exact same commodity that Americans could theoretically purchase for $75. This was not a small discrepancy or a temporary blip. This was an 18.7% premium that violated fundamental principles of how global markets are supposed to function. In classical economic theory, such price gaps cannot persist. Arbitrage traders exist specifically to exploit these inefficiencies. The mechanism is elegantly simple. A trader buys the underpriced asset in one market, simultaneously sells it in the overpriced market, and pockets the difference with virtually no risk. When gold trades for $2,000 in London and $2,050 in Hong Kong, arbitrageurs immediately buy London gold and sell Hong Kong contracts. Their actions force the prices back together within minutes. The profit opportunity attracts so much capital so quickly that the gap closes before most people even notice it existed. This is how global markets maintain price unity across continents and time zones. Yet here was silver, one of the world's most liquid commodities, trading with a $14 spread between major exchanges with no apparent correction mechanism activating. The mathematical reality was straightforward enough to verify. The Shanghai front month contract showed 20,730 yuan per kilogram. The current yuan to dollar exchange rate hovered around 7.3 to 1. Simple division converted the yuan price to dollars. 20,730 divided by 7.3 equals approximately $2,840 per kilogram. Silver is measured in troy ounces, not kilograms, requiring one additional calculation. Each kilogram contains 32.15 troy ounces. Dividing 2,840 by 32.15 yields $89 per troy ounce. The math was not ambiguous. Chinese buyers were paying $89 while Americans panicked over $75. Three specific barriers were preventing the arbitrage mechanism from functioning. First, capital flow restrictions made it extremely difficult to move money in and out of China freely. A Western bank could theoretically ship silver to Shanghai and receive yuan payment, but converting those yuan back to dollars and repatriating the funds involved navigating complex currency controls and approval processes that could take weeks or months. The $14 profit looked attractive until one calculated the cost of having capital trapped in Chinese currency for an indefinite period. Second, physical logistics created timing and cost barriers that eroded theoretical profits. Shipping silver across the Pacific required ocean freight, insurance, customs clearance, warehousing, and quality certification. These costs alone consumed several dollars per ounce before considering the time value of money during the multi-week shipping process. The third barrier was the most significant. Chinese regulatory authorities were implementing new export licensing requirements for silver, effective January 1st, 2026. Any silver shipped into China after that date would become subject to government-controlled export licenses for any future removal. This effectively transformed China's silver market into a one-way valve. Metal could enter, but could not easily exit. For arbitrage to function safely, traders need the ability to reverse positions if market conditions change. If a bank shipped 1 million ounces to Shanghai to capture the $89 price, they needed confidence they could retrieve that metal if necessary. The new licensing regime eliminated that confidence entirely. The risk of having physical silver permanently trapped behind regulatory barriers far exceeded the apparent $14 profit opportunity. This created what market analysts call a bifurcated market structure. Two distinct pricing mechanisms now existed for the same commodity. In the West, silver functioned primarily as a financial instrument. Traders bought and sold futures contracts, options, and exchange-traded funds with no intention of ever touching physical metal. Settlement occurred in cash. Price responded to speculative flows, technical trading patterns, and algorithmic signals. The overwhelming majority of transactions involved paper claims on silver rather than actual bars and coins. In contrast, Eastern markets were increasingly dominated by physical transactions. Chinese manufacturers needed actual metal to build solar panels, batteries, and electronic components. They could not operate factories with futures contracts. They required delivery of tangible silver to feed production lines. When they bid $89, they were expressing urgent need for physical supply, not placing speculative bets. Historical precedent offered instructive parallels. During the 1960s, the London Gold Pool attempted to maintain gold at $35 per ounce through coordinated central bank intervention, while private markets valued it far higher. The pool eventually collapsed when physical demand overwhelmed the paper price suppression mechanism. In 2022, the London Metal Exchange faced a crisis when nickel prices diverged catastrophically between paper contracts and physical metal, forcing trading halts and contract cancellations. These episodes demonstrated that when paper and physical markets divorce, resolution typically favors physical reality over financial abstraction. The question facing silver markets was not whether this gap would close, but how and when the reconciliation would occur. 3 days remained before the global silver market would undergo its most significant structural transformation in generations. The calendar showed December 29th. The regulatory deadline showed January 1st. Between these two dates existed a narrow window that sophisticated industrial buyers understood with absolute clarity. Chinese manufacturers were not paying $89 per ounce because they enjoyed overpaying. They were paying $89 because they had performed a calculation that most Western traders had not yet completed. They had asked themselves a simple question: what happens to our factories, our production lines, our contractual obligations to customers when the world's largest refining nation stops exporting silver? The new export licensing regime represented something fundamentally different from a tax or a tariff. Taxes can be calculated into cost structures. Tariffs create predictable price adjustments. But licensing requirements introduce bureaucratic uncertainty that no spreadsheet can adequately model. Under the new Chinese regulations, any entity wishing to export silver would need to apply for government approval through a formal licensing process. The application would require detailed documentation of the silver's origin, intended destination, end use, and strategic justification. Government officials would review these applications according to criteria that remained deliberately vague. Approval timelines were not specified. Appeal processes were not outlined. The entire mechanism was designed to give state authorities maximum discretion over whether silver could leave the country. Anyone with experience navigating Chinese regulatory systems understood what this meant in practice. Licensing approvals that theoretically could be granted in days would likely take weeks or months. Applications would be denied for unstated reasons. Even approved licenses might come with restrictions on quantity, timing, or destination that rendered them commercially useless. The bureaucratic complexity was not accidental. It was the primary enforcement mechanism. China was not building physical walls around its silver refineries. It was building procedural labyrinths that would effectively trap metal inside the country without technically imposing an outright ban. This approach provided political deniability while achieving strategic resource control. The mathematics of supply disruption were straightforward but alarming. China controlled approximately 20% of global silver refining capacity and 15% of mine production. The global silver market already operated in deficit, with industrial consumption exceeding mine supply by roughly 200 million ounces annually. This deficit had been managed through above-ground inventory drawdown and recycling, but removing 20% of refining capacity from a market already running a 200 million ounce deficit created an immediate crisis. Western manufacturers who had relied on Chinese refined silver for decades would suddenly need to source that metal elsewhere. But there was no elsewhere with spare capacity. Global refineries were already operating near maximum utilization. Silver production cannot be ramped up quickly. New mines require 7 to 10 years from discovery to production. Existing mines cannot simply dig faster. Industrial buyers had completed these calculations months earlier. Solar panel manufacturers in particular faced existential pressure. Each solar panel requires a specific quantity of silver paste for electrical conductivity. There are no readily available substitutes that maintain efficiency and cost effectiveness at scale. A major solar manufacturer producing 1 million panels monthly needs roughly 15 to 20 tons of silver every 30 days. Any disruption to that supply chain means production lines stop, contracts default, and revenue evaporates. These companies were not speculating on silver prices. They were securing survival inventory. When they saw $89 in Shanghai while New York showed $75, they did not hesitate. They bought at $89 because their alternative was buying at $100 or $120 later, or worse, not being able to buy at any price. Electric vehicle manufacturers faced parallel pressures. Modern EVs contain 30 to 50 grams of silver in various electrical systems and battery management components. Next-generation vehicles with advanced power electronics could require 500 grams to 1 kilogram each. With global EV production targeting 30 to 40 million units annually within 5 years, the silver requirements were staggering. Tesla, BYD, Volkswagen, and other major manufacturers were all conducting the same supply chain risk assessments. They were all reaching the same conclusion: secure silver supply now, regardless of price, or face production disruptions that would cost far more than any premium paid today. Electronics manufacturers completing smartphones, tablets, laptops, and other devices faced identical calculations. Every circuit board contains silver. Every electrical contact uses silver. The quantities per unit are small, but the unit volumes are enormous. Samsung alone produces hundreds of millions of devices annually. A supply disruption measured in weeks could cascade into revenue losses measured in billions. Procurement departments at these companies were not asking whether to buy silver. They were asking how much inventory buffer they could financially justify holding. Many were concluding that 6 months of forward inventory, normally considered excessive, was actually prudent risk management given the January 1st regulatory change. Government strategic reserve programs added another layer of demand that rarely appeared in public statistics. Multiple nations were quietly accumulating silver as a strategic resource, recognizing its critical role in defense systems, renewable energy infrastructure, and technological independence. These purchases were not speculative. They were policy-driven efforts to ensure national security and economic sovereignty in an increasingly fragmented global economy. When governments buy commodities for strategic reserves, they are generally price insensitive. They buy the quantities their strategic planning determines are necessary, regardless of current market prices. This demand was largely invisible to retail traders watching price charts, but was very real to the physical market. The 72-hour countdown created a specific psychological dynamic. Rational actors with genuine physical needs were compressing future purchasing decisions into the present. Procurement that might normally spread across weeks or months was being executed immediately. This front-running behavior was not irrational speculation. It was logical preparation for a known regulatory event with predictable supply chain consequences. The question facing Western markets was whether they would recognize this reality before the calendar flipped to January 1st, or whether recognition would come too late. Markets do not resolve structural dislocations through gradual adjustment and polite negotiation. They resolve through violence. History provides consistent evidence that when paper prices diverge significantly from physical reality, while a major supply disruption approaches, the reconciliation comes suddenly and overwhelmingly in favor of physical markets. The pattern has repeated across commodities and time periods with sufficient regularity that it approaches predictive reliability. What remains unknown is not whether reconciliation occurs, but precisely when the trigger pulls, and how severe the adjustment proves to be. January 2nd represented a specific inflection point where multiple forcing mechanisms would converge simultaneously. Western institutional trading desks would return to full staffing for the first time since mid-December. Senior risk managers who had been absent during Ghost Week would sit down at their terminals and conduct their routine morning market assessments. They would pull up silver positions. They would check overnight price action in Asian markets. And they would immediately notice something that should not exist. Shanghai would still be trading near $89. New York would still be showing something in the mid to low 70s. That $14 to $15 spread would not have magically disappeared over the New Year's holiday. The senior traders would begin asking their junior counterparts what had happened during their absence. The juniors would explain the Ghost Week volatility. And the seniors would ask a different question entirely. They would ask whether anyone had checked physical availability. Phone calls would begin. Procurement departments at manufacturing firms would contact their usual suppliers, requesting quotes for large silver purchases. The responses would come back very different from what buyers had grown accustomed to. Premiums over spot price would be substantially higher. Delivery timelines would be extended. Some dealers would simply say inventory was unavailable at current prices. The procurement managers would escalate these conversations to their supply chain directors. The directors would escalate to their chief operating officers. And suddenly, what had seemed like a financial market story would become an operational crisis story. Companies would realize they could not source the physical silver they needed to maintain production schedules at anything close to the $75 paper price. Two distinct categories of buyers would respond to this realization with urgency that would overwhelm normal market mechanisms. The first category consisted of manufacturers with immediate production needs. These firms required silver not for investment purposes, but for operational continuity. When a solar panel manufacturer discovers it cannot source silver to keep assembly lines running, price becomes secondary to availability. The company faces a binary choice: pay whatever price secures the metal, or shut down production and face penalty clauses in customer contracts that would cost far more than any premium paid for silver. These buyers would begin placing orders with urgency that disregarded normal budgeting constraints. They would buy at 78, at 82, at 86, at whatever price moved them to the front of the allocation queue. The second category consisted of institutional investors and hedge funds that would recognize the arbitrage opportunity once liquidity returned to the market. These entities would observe the persistent Shanghai premium and understand that Western paper prices had dislocated from physical reality. Unlike physical manufacturers, these funds would not need actual delivery. They would simply need to position long in Western futures markets ahead of the inevitable repricing. A hedge fund buying silver futures at $76 with the knowledge that physical markets were clearing at $89 was making an asymmetric bet with favorable odds. Even if they were only partially correct about convergence, the risk-reward ratio justified significant position sizing. Multiple funds reaching this conclusion simultaneously would generate buying pressure measured in hundreds of millions of dollars, hitting the market within hours of the New Year's opening bell. This two-pronged demand surge would encounter a market structure that was fundamentally unprepared to deliver physical metal at scale. The COMEX registered inventory, which represents silver available for delivery against futures contracts, stood at approximately 70 million ounces. The total open interest in silver futures exceeded 900 million ounces. This created a leverage ratio of roughly 13 to 1. For every physical ounce available, 13 paper claims existed. This ratio functioned adequately as long as only 2 to 3% of contracts actually demanded delivery. But what would happen if 5% demanded delivery, or 8%? The exchange would face a delivery crisis. It would be contractually obligated to deliver metal that did not exist in its warehouses. Historical precedent suggested several possible exchange responses. The first option would be forced cash settlement. The exchange could invoke force majeure clauses and simply pay cash to contract holders instead of delivering metal. This would preserve the exchange's solvency, but would shatter confidence in the integrity of futures markets. Investors would learn that when delivery pressure mounted, contracts would be cash settled at prices that did not reflect physical market reality. The second option would be rule changes implemented retroactively. The exchange could modify margin requirements, position limits, or delivery specifications to reduce stress on the system. Such changes had occurred in other commodity markets when delivery crises emerged, but they generated lawsuits and regulatory scrutiny that damaged market credibility for years afterward. The third option, and the one that market structure made most likely, would be a price surge sufficient to discourage delivery demands. If futures prices rose rapidly enough to close the gap with Shanghai, most contract holders would choose to take profits on their positions rather than stand for delivery. A move from $75 to $85 or $90 would satisfy most long holders while removing the arbitrage incentive that was driving delivery demands. This outcome would preserve exchange functionality while transferring substantial wealth from short sellers to long holders. The entities caught short at $75 would face margin calls and forced covering that would accelerate the upward price movement. 3 specific market behaviors would signal which resolution path was activating. First, volume patterns on January 2nd would reveal institutional conviction. If volume returned to normal levels, but price remained suppressed near 75, it would suggest institutions believed the ghost week decline reflected genuine fundamental weakness. But if volume surged while price gapped higher at the open, it would confirm that capital was rushing to correct the mispricing. Second, physical premiums at retail dealers in Western markets would indicate whether delivery tightness was spreading beyond industrial channels. If premiums over spot widened significantly, it would demonstrate that the supply constraints were affecting all physical buyers, not just Chinese manufacturers. Third, registered inventory levels at COMEX would reveal whether delivery demands were actually materializing. A sharp decline in registered ounces would prove that longs were standing for delivery, forcing the exchange closer to a potential default scenario. Strategic positioning for different market participants required acknowledgement of multiple possible outcomes. Retail traders holding physical silver faced minimal risk from short-term volatility. Their metal was not subject to margin calls or forced liquidation. They could afford to maintain positions through volatility and wait for physical market realities to assert themselves in pricing. Traders holding leveraged futures positions faced substantially higher risk. A volatile resolution could trigger stop losses or margin calls before the ultimate repricing occurred, removing them from positions that would eventually prove correct. Manufacturers requiring silver for production had no strategic optionality. They needed to secure supply regardless of price, making them price-insensitive buyers who would absorb available inventory at prevailing rates. The $75 price point on December 29th would be remembered as either opportunity or a warning depending on what unfolded in the following weeks. If industrial buyers continued paying $89 in Shanghai, while Western prices remained suppressed, it represented a profound arbitrage opportunity for anyone with access to physical delivery channels. But if demand destruction began appearing in manufacturing data, if recession fears proved justified, if Chinese buyers suddenly stopped paying premiums, then $75 might represent fair value for silver in a contracting global economy. The difference between these scenarios was not subtle. It was the difference between 50% upside and 20% downside. Strategic capital allocation required not certainty, but proper assessment of probability, weighted outcomes, and position sizing appropriate to conviction levels and risk tolerance. What could not be disputed was that the configuration of factors present in late December 2025 was historically unusual, thin holiday liquidity creating exaggerated volatility, massive price divergence between paper and physical markets, regulatory changes scheduled to sever a major supply source, record deficits between production and consumption, and institutional positioning that suggested smart money was accumulating rather than distributing. This combination of factors did not guarantee any particular outcome, but it created conditions where rapid repricing became more probable than gradual adjustment. Market participants monitoring these developments would know within days whether the ghost week decline had offered strategic opportunity or delivered strategic warning.